Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 92. As always, joined by the three amigos. We got Keith Dicker here with his green shirt and Rich Diaz over in Montreal. Welcome back to the show, gentlemen. Keith, you got a new shirt and you got a whale in the background.
Yeah, I know. It's funny because until I met you guys, the only comments about my attire, it's never been very positive. It's always been a bit on the... So I love it. Yeah. You know, I like t-shirts. This is my Respect the Locals t-shirt.
Does Miss Ice Cap dress you? She pick your stuff?
Sometimes. Yeah. And my mom's visiting for a few days, and she, if you're watching the video version, she gave me a little it's like a whale. You know, you hang out on your window so the sun will shine through and stuff. So that's what you're seeing there now.
Very cute.
Rich, give me some mom tips. What can you share with me?
Well, we figured out why the air conditioning wasn't working. It's because it was on econo mode this whole time.
She's just leaking, and
that's right. So now we're all good. Next, as tomorrow morning, I'll be heading up to the country. I absolutely love the woods. And years ago, I bought some land. You call me a prepper, call me whatever you want, but I'm gonna go up to the woods and chop some wood and go fishing and go swimming in the lake. It's sort of the best thing to do, really.
Yeah, you got like a big parcel of land there. You said you're going to build like a big cabin or something at some point.
We'll see. Definitely a bunker of some kind. Yeah, no, it's been since I've been actually, you know, the truth is, since I read the book by Mordecai Richler called The Apprenticeship of Duddy Kravitz, which I would recommend everybody to read. It's a book about a Montrealer who tries to buy some land. And anyway, it's a brilliant, very hilarious book. And if you're from Montreal or from Canada, I think you'd really appreciate it. And so I read that book years ago. And then a month later, I got paid a bonus. And then within a month of my bonus, I plunked it all down on this land. And my mom thought I was absolutely nuts. Turns out it was actually a great idea. So all these years later, that's really my dream. But anyway, that's boring. Let's talk about loads of stuff. What's going on with you, Steve?
Next Loonie Hour events in Montreal.
Yeah, that's right.
Bring an axe.
Bring an axe, bring a shovel. You're welcome to come and hang out.
Lots going on this week. We've got the Bank of Canada, obviously big announcement from them. We had the US CPI data. Just a lot of stuff going on in China, federal government, OSFI. Tons to talk about this week. Funny enough, I don't know if we actually chatted about it. We totally forgot to prep for this week's episode, but we did have a Twinkie bet on the US.
I'm ready. You won. I've got it. I've got the Twinkie.
You're back. You're back in Canada. The Twinkies are available. Keith, what do you got? So was it non-farm
payrolls, and you guessed 209 or something, and it was it was you got it right. Tell us.
Yeah, well, I think what was the estimate? It was like
225.
I guessed 224, and I think it was in the low twos. It was lower than even what I had.
And there was downward revisions, I think, from the previous month. And interestingly, which I thought was really crazy, was there was a huge contribution from the federal government. Which can be fine. I mean, it's neither here nor there, but I think it was 60,000 jobs were from Uncle Sam, which I thought was a really interesting, very high number. So it was actually not a great non-farm payrolls day. I don't know, Keith, if you want to show us.
Keith, is that a lemon loaf?
Well, it wasn't a great non-farm payroll day if you were betting on it and you missed by a boatload, which what I did. But it's kind of interesting because a lot of the economic data come out of the US, especially on the labor market, it's been pretty strong all the time. Like, it hasn't been surprising to the downside. And I think everyone will know by now that, employment data can be a bit volatile, from one month to the next. But this number, it was a miss. Like, it was a very soft number. So that gives the market confidence that the Fed won't be hiking again. Notice how we keep going back and forth to that narrative. And at the end of the day, the Fed, they still hike. So that this continues to be on my expectation. But I completely forgot about the lemon loaf, but I do have a date square. So do you guys know what a
square, man?
You know what a date square is? Have you heard
they're
of
find
delicious
these things?
They're delicious.
Yeah. Dates, brown sugar, some
that
baking
sounds like
soda,
that
and
sounds
powder
like
go in
something
with
you
it.
get when you win the bet.
Yeah, that's definitely that
But
doesn't count.
anyways,
Well, I guess I won the bet today because I'm going to eat a date square. I love date squares. They're yum.
So we had a big Bank of Canada announcement as well. Obviously, as expected, I don't think anything out of the ordinary. 25 basis point move from the BOC. So that brings the overnight rate now to 5%, highest since 2001. And, I think it was interesting just to hear some of the commentary from Macklem. I think we all, like Keith and I for sure, watched the press conference. And basically, like the headline was more like, the BOC doesn't see them returning to that 2% inflation target or whatever you want to call it by middle of 2025. So they've pushed that out 6 months. Now, again, I'd probably just caution everybody that they also said, a year and a half ago, they said they weren't going to raise rates until, the end of 2023. So in terms of forecasting and predictions, I mean, let's take that with a grain of salt. I think that if you actually look at their monetary policy report, I think they have like annualized inflation for like next year, 2024. They have inflation basically coming in at 2.5% for the year, right? So it's not like, okay, guys, like I would argue, I mean, they do have an inflation band between 1 and 3. So like, is 2.5 such a bad thing? I would argue probably not. Didn't the BOC, what are the average 1.8% inflation over the last decade previously?
Yeah, it's been on their target, but so is everyone else, right? So let's be
clear here. I don't like the way you just worded that, Steve.
No.
The Bank of Canada achieved a 1 point. I think it goes something like inflation was this number, and the Bank of Canada happened to exist during that time.
Let me just
confuse. Rich loves that, right? But never confuse causation with correlation. That's the way you word it.
Let me save myself here, because I remember I think it was actually the Fed where they said, inflation had averaged just under 2% for the past decade. Hence they ran zero rates and a whole bunch of QE as an excuse. And they said, I think it was Yellen, she said, inflation is the challenge of our lifetimes. Was it something along those lines? Because they were hitting like 1.8 instead of like 2. And it's like, who cares?
Well, no, not only that, they were starting to interject. Not only that, remember, it was just a couple of years ago, they were talking about raising the inflation target and doing inflation averaging in order to increase sort of the, run rate of inflation. And I would just say, chalk that up for be careful what you wish for. But anyway, let's bring it.
Well, the big problem that they had for over a decade was that there was no inflation anywhere. And they just couldn't figure it out. And, if you guys may not remember, but back when Greenspan was running the Fed, he called it what do they call it? I forget his famous quote now. A conundrum. It was a conundrum. Yeah. In that, growth in the US in the early O's was like, well, this was after 02. Yeah. Like in 5 and 6, it was like, 5% growth, 5.25, 5.5, and inflation, like nada. There's nothing there. And I think that's what Yellen was alluding to there a few years ago. So, the big challenge of their lifetime is trying to create inflation. And as you said, Steve, now like, just flip it over so fast. Now now we have too much inflation. And again, I think the ego that central bankers have, I think it's enormous. Like it's bigger than, like Fonzie had a big ego, but he deserved it because he could do cool things. And this sort of goes back. I thought this week's Bank of Canada announcement and the presser, if you start reading between the lines, were so many awesome conflicts taking place, and you're aware of them or you're not. And maybe we'll talk about some of those. But it's obviously, Steve, you picked up on one immediately during the presser. You were texting me and you said, yeah, they reference population growth now, like a number of times and stuff. So there's obviously, and this is a theme that, Rich, you've touched on quite a bit as well. Like there's so much stimulus in Canada from fiscal spend and then from population growth. And then, the lads at the BOC, they're expected to somehow offset it by raising rates, but not too much, because you don't want to, hurt everyone. So I keep going back. You guys joke if you're head of the Bank of Canada, you would quit. That's the first thing you would do. If you weren't allowed to quit, people got mad at me a few weeks ago, but I'd hike rates 50 basis points or 100. Just shut it down, because if not, we're going to be back in the same position we are here in another month or two.
Yeah, there's some really good takeaways. I think that Tiff Macklin there and was it Carolyn Rogers? They had mentioned, population growth probably I'm going to say at least 7 or 8 times, Keith. And one of the questions was, so Bank of Canada said in their monetary policy report, they said, quote, "The previously unforeseen strength in house prices is likely to persist and boost inflation by as much as 0.3 percentage points by the end of 2023. So essentially what they were saying was that, housing, which is the most interest rate sensitive sector, has been surprisingly resilient, and we've actually seen house price growth this year. And it was one of the reasons for them raising rates back in June, and of course again here in July. And so these reporters are all kind of like, well, why are you projecting like higher house prices? Are you not surprised by this resiliency? And she basically just said, we have this supply demand imbalance, and the biggest driver of demand right now is population growth for the demand for housing. And so I found that quite interesting. Obviously, Rich, I know you've been hammering that point home, but
yeah, it's just tough. I mean, it's like maybe should we go over some of the stuff we talked about yesterday for some of the people who didn't listen
Fire
to
away.
our Twitter
Yeah.
Spacers? So, I mean, it's just, again, so that was, I thought, was really interesting. Again, something we harped on was their projections for GDP growth. So Keith's going to touch on that, but I just thought it was really funny that they still seem to skirt over the fact that they project real GDP growth to grow lower than population growth. And some quick math will tell you that effectively they're telling everybody that they're just going to be poorer. And they actually reflect that in the monetary policy report, where they say, consumer spending and business investment are both expected to decrease. And I think it's important that they add on a per capita basis. I think that's even more obvious. I think that in general, I think that one thing that Keith highlighted yesterday, sorry, I'm stealing it from you, Keith, I think it was that they pushed out their inflation projections again. So I thought that was also really important. And yeah, so we'll see. I mean, I don't know. Yeah, sorry, I'm waffling here a little bit, but Keith, you want to just save me?
I don't remember a lot about yesterday, but what Rich is referring to is that the Bank of Canada's expectations where the economy was going to move and inflation was going to move, they feel it's going in the right direction. It's going the direction that they've been forecasting, but it's going to take longer to get to the end game or the final result they want. Basically, that's what it is. So, originally they're expecting to achieve, the job is finished by the end of 2024. Now they're saying it'll maybe take place in the middle of 2025. So that's where you get that 6-month, pushback. Or
Rich, Keith, I got a quick question for you, because I know the audience that's listening to this is probably going to ask the same thing, which is, okay, so if the Bank of Canada, again, this is hypothetical, what's your interpretation of it? The Bank of Canada is telling you, we don't see us hitting our target now till another 6 months out, so the middle of 2025. Does that assume that the Bank of Canada, because they haven't hit their target, quote unquote, that they would basically hold rates at these levels until they hit that target in middle of 2025?
Yeah, I love the question. So right now the market is expecting that the Bank of Canada is now done again. They've reached peak velocity, maybe, if you want to use that word. The Bank of Canada clearly stated that they are now data dependent from one meeting to the next. Remember, they paused in January, and then they raised by 25, and now another 25. And as they will tell you, they think they're achieving their job. They're doing exactly what they were meant to do. Steve, you mentioned they have a big sort of sledgehammer is really the main tool that they use to do things. And whether they hike rates again, we'll have to wait and see. But they were hawkish, but they were soft about it. That's the way it came across.
I would say there was a lot of good questions. Like I watched the whole interview presser, and I would say like the journalist questions, I would say for maybe one of the first times weren't actually softballs. I think there was actually some good questions. One of the guy was grilling him, being like, why did you go on pause? Was it he actually said, was it irresponsible for you to come out and say, hey, we're pausing in January? Because like obviously the housing market sort of took a bit of a lift off after that. And, Macklem kind of refuted that, basically saying, our data suggested that we should sort of pull back and wait and assess. And we waited and assessed, and that's why we're moving again. They had that. Someone was asking him about, hey, headline inflation is at 3.4. You strip out shelter inflation, mortgage interest costs, which is your sole doing, and you're at 2.5% CPI. Should you be still raising rates in that environment? And he was like, well, no, you can't strip out one thing out of the basket. We have to look at all of the items in the basket. So I think he answered a lot of questions that were on Canadians' minds. But Keith, to your point, yeah, it seems like data dependent. I don't know if you've got the Bloomberg terminal open now, but I'm kind of curious what the markets are pricing in, maybe not only for this year, but like when they're pricing the first cut from the BOC. Sorry into the show. Just want to remind you guys, the Loonie Hour live event in Vancouver is taking place July 27th at the Hollywood Theater in Kitsilano, Keith's favorite spot. Come hang out with us on July 27th for food, drinks, live podcasts, Q&A, pictures, questions, all the good stuff. There is a Eventbrite link in the show notes below where you can get your hands on some tickets. Looking forward to seeing you all there, and we appreciate your support.
I'll pull that up here as we chat. But I want to remind everyone that the Bank of Canada, as well as the Americans and the Brits, Europeans, they're looking at inflation data, they're looking at the economy and stuff like that, but they keep coming back to the strength of the underlying labor markets. So the only way you're going to get demand to slow, which if you have less people buying things, that will bring the price of things down. They need to see job losses or significant less job growth. So the Americans had a bit of that, this last week with the employment number, and so let's continue to watch that.
But on the jobs data stuff, funny enough, Rich, is what the public sector has expanded since 2015. The public sector growth has grown by 40%.
Yeah, so you have to be careful. So this is the mistake I made, and so I'm happy to share. So there's different ways that you can look at public sector. So there's public sector there's something called public sector. That's, literally everybody who gets a check from a municipal government, local government, federal government, whatever. Then there's something called public administration, which again is sort of a more narrow sliver of that, naturally. And then there's something called core public administration. And that's from let's say, I'm looking at the number right now. It's like a federal, that you got the federal government. And it's the federal government number that in 2015 was 195,000 and now is 270. So that's about 40%.
Number of employees.
Yes, excuse me. Sorry, excuse me. Yes, the number of employees. So if you look at public sector full stop, we're up 20% over 10 years. Been a huge jump. And then, if you're looking at public administration, there's also a huge jump. And now an astute listener will say, oh, but it doesn't matter what the absolute jump in absolute number matters. What matters is the share of population growth, which is a fair counterpoint. And on all three metrics, there's been a huge jump in a common size number. So relative to the total amount of people working, Steve.
Right. So essentially, yeah, government employees are obviously expanding, which tends to make, again, the BOC's job a little bit more challenging.
Well, that's actually, they say that exact same thing. Bit. Well, they actually said they don't exactly say that, but they say the upward revisions to the inflation outlook were due to more persistent excess demand, higher than expected house prices, higher tradable goods. Okay, that makes sense. That's sort of external. But so 2 of the 3 already are controlled directly by government policy. And then the other ones, they said, other factors contributing to the upward revisions to consumption are tighter than expected labor market. That's interesting. Okay. That's more endogenous. But then greater pent-up demand for services. And then the last one, which they snuck in there, and I'm actually quite proud of these guys for doing this, because I think they're going to get some heat, which was fiscal measures in recent federal and provincial budgets, Keith. So, and what that means is obviously the deficit spending and population growth. So I'm surprised they actually threw it in there. It's box 2 of the monetary policy report. You're welcome to check it out for yourself. But that's it. I mean, this is what we've sort of outlined for a long time. It's very difficult for the Bank of Canada to get to their inflation target when you have, when they're basically paddling upstream. Not to.
So as a result, you're going to have, one would imagine, anyways, hypothetically, you should have structurally higher interest rates, assuming.
One should. So you'd have your something called a NAIRU, which is another acronym that I totally forget what it is. So I'm quickly looking. It's
drum roll.
Drum roll. I forget. It's NAIRU is a non-accelerating inflation rate of unemployment. So it's the unemployment. It's how your labor market is reacting to your inflation, basically. And each country will have a different one. It depends on population, age, demographics, productivity, what have you. And if you have a lot of deficit spending and a lot of and population growth, naturally your interest rates should be structurally higher, and inflation rates structurally higher.
Isn't there a board game where like you everyone will get like an acronym? You have to try to guess out. Right. What was that game called?
I can't remember. It's like some of the Balderdash. Is that it? Something. Yeah,
yeah, absolutely. Yeah, maybe we should do a Loonie Hour one. With investment themed ones. But this goes sort of back to what we introduced there a couple of minutes ago with the Bank of Canada meeting this week. I would suspect they have a lot of frustration, and now that it's starting to come through in their reports and publications, as well as the pressers. I think they are incredibly frustrated, with trying to do their job when there's so much pushback coming against them on the fiscal side. And even yesterday, after the Bank of Canada came out, Trudeau was out commenting on it, and so was Poilievre. I don't know if Jagmeet
Singh had some comments too. Yeah, he
said they were positive. They were quite positive towards the central bank policy.
No, I can read them for you. What's the Bank of Canada's what are the market? Oh, here, I'll read Singh's right now. It says another mortgage bombshell has been dropped on Canadians. Today's interest rate hikes put pressure on working people who are already struggling. Meanwhile, greedy CEOs contributing to inflation are left unscathed. Justin Trudeau's lack of action has left you to pay the price. Oh boy.
Looks like the election coming up, hey? But let's be realistic here again, so that everyone agrees with what we're articulating. One of the biggest single contributors to inflation here in Canada and the strength of some underlying markets is population growth. It's also the fiscal stimulus, and that's coming from governments as well as Canada's contribution to most of, really the Western world, their policies towards the pandemic back in 2020. And governments today, it doesn't matter if it's Canadian government or the American, anyone else, and they won't look in the mirror. All of these, like inflation today, it's not a problem. It's a symptom of a much bigger problem. And the response that governments are giving or providing, to these symptoms, for example, in Ottawa right now, they're giving out stimulus checks or, monthly subsidy checks, for people with lower family incomes to help with food prices and stuff. Again, that's just looking at the symptom. The symptom of inflation is because governments are spending more, governments are bigger, they want to be bigger. And that's something that we should continue to expect, because the pendulum in Canada for the last 5 or 6 years, whatever it's been, is clearly been swinging towards socialism. Socialism is an economy that is directed by and driven by capital allocation decisions that's encouraged by the government instead of the private sector. And Rich, you pointed out numerous times, Canada is really excuse me, Steve, but it's aside from housing, but as Rich will tell you, there's one economy or one part of our economy is doing very well. Then that is a net exporter. It's really helping, but we're not attracting foreign capital into the country. So until this pendulum swings, we should expect to see this, which means you got to expect the Bank of Canada to remain frustrated. Now, unless there's an accident of some kind coming, maybe they will hike again. Steve, to answer your question, there are no more rate hikes expected right now to the end of this year for the Bank of Canada. There's a small percentage they hike a tiny smidgen, but the smidgen is not a statistical probability.
And when is the market got
right.
for first cut?
Oh, there's no cuts. They're not pricing in any cuts.
They haven't
right
priced
yet.
even like into 2024.
No, 12 months out, it's still flat.
Yeah.
Okay.
There's one more. Sorry,
again,
just Keith on the other. Oh, sorry. Go ahead.
Yeah, but again, I really want to emphasize that the government of Canada, we mentioned before, I think France is number one in the world in terms of government becoming a part of the overall economy. Canada's catching
in developed
up quickly.
markets. In developed markets.
Correct.
Right? There's emerging markets that are. Anyway, sorry.
Yeah, and Canada is catching up here, very quickly. And something, if I'm a private investor around the world, I need an incentive to want to invest somewhere. And Canada is obviously not that attractive at this point in time.
Sorry, there's one angle, Keith, that you forgot to mention, and I think that our government always forgets to mention, and it seems like everyone, I feel like I'm taking crazy pills. Productivity growth. It's also, that's the other side of that coin, which is, so a small pushback is what in theory, one could have a large government you could, I mean, I wouldn't recommend it, but one could have government be a large chunk of your economy if you have a significant amount of productivity growth. But obviously, usually those are not necessarily related. But the problem with Canada is we have very, very, very poor productivity growth. And then we have done so for a long time. I mean, I've referenced, research and development spending, so I won't get into that too much. But that's the other point that we seem to fail to talk about, and we need to bring and make that more of a sort of part of the conversation is the productivity growth piece, and Canada's really doing quite badly. And just to avoid any comments about me not knowing what I'm talking about, which is sometimes true, the NAIRU is the non-accelerating inflation rate of unemployment, a theoretical level of unemployment below which inflation would be expected to rise. There you go. That's what it is. Sorry. So anyway,
that's a mouthful right there.
Yeah, I know.
Yeah, but I mean, you're speaking on that front here, wrapping up the sort of the BOC stuff. Obviously, again, they've talked about housing and being more resilient. I think what I'm seeing anecdotally in the market is things are slowing rather aggressively. The end of the spring market / sentiment is starting to change once again. Still running into inventory issues, but interesting point too, Keith. I don't know if you saw this, but OSFI was out this week, so it's the bank regulator. Talking again, there's been a lot of conversation about these variable rate mortgages and what to do with these, amortizations that are growing. People's mortgage balances are actually not contracting; they're growing because their interest is being basically deferred and tacked onto the balance. And so OSFI has come out this week and said we've got a proposal in the works that says that any of these banks that have these variable rate mortgages that are basically, the amortizations are blowing out, we're going to force the banks to hold more capital against those loans up to, so basically if the loan to value exceeds 65% loan to value, they're going to require the banks to hold more capital against those loans. And so just for those that are maybe wondering, it wouldn't have any implications on people that already have variables. So let's just say you have a variable with TD Bank, and your balance is growing because you're not adding anything towards the payment because you've hit this trigger rate. You essentially would be fine. It's moving forward, and it sounds like this OSFI change will come in probably Q1 of 2024. Expect a lot of these banks to change their variable mortgage product for new issuers. So, for example, they could do what RBC does, which is RBC forces their borrowers to pay all of the interest. So you can't defer the interest. You have to pay all of the interest. Or you could do what Scotia does, which is they literally have a true floating rate, which is your your interest and your mortgage payment will go up at every Bank of Canada rate hike. So expect a lot of the Canadian banks to follow down that path in Q1 of next year.
It's sort of tying into that whole, because the whole theme is about, household credit, basically. I mean, that's what we're talking about here. One item that was mentioned a couple of times during the Bank of Canada meeting this week was, and they were framing it as a positive discussion. And I don't think it's positive at all. I think it's the opposite. They talked about how Canadians are using savings to help to supplement their spending now. So, and the reason they built it as being a positive contributor was because people accumulated excess savings since the pandemic. Because, most people continue to get paid, work from home, you have less spending less money and stuff. So you accumulate a lot of money. Not a lot. Some households accumulated more cash and savings. But if we continue to go down this path where households, not only in Canada, but in America and elsewhere, where you have to use savings to supplement your day-to-day living, eventually the savings, it does run out, it gets dry. So that was something else that came up. And it sort of led into, I think it was the third question on Wednesday. Because it was yesterday. Today's Thursday. We record on Thursdays, right? And yesterday was a Wednesday.
Yeah, it was yesterday.
It was. Yeah. I'm in t-shirt mode.
Check your show notes, bud.
But the third question was basically the reporter was saying, the stress on households the Bank of Canada was sort of indicating that there wasn't a lot of stress on households from an aggregate level.
Good point.
Because that they were saying that households, we're in pretty good shape because they have excess savings. And this reporter said, well, it's actually not the case. There are a lot of households that are struggling out there. They are using savings, to supplement, their monthly or regular spending cycle. And they also mentioned, about 50% of Canadians are, $200 away from, having a challenge. And I thought it was such a great question. And the question just landed on deaf ears at the Bank of Canada yesterday. They didn't really get into that. But if they want to, try to become endearing to people who are watching, because more people are watching it, they kind of need to be a bit more empathetic, at least, to what's happening. Because it ain't happening.
Sorry to interrupt the show again. I just wanted to make a big announcement here for our Calgary listeners. We are coming to Calgary on Saturday, July 29th. We have rented out the Inglewood Lawn Bowling Center. So if you want to come hang out with Keith, Rich, and myself, we have rented out the entire Inglewood Lawn Bowling Center. $20 gets you admission, unlimited drinks, including booze, food, pizza, etc. It's going to be a great time. Kind of come and go as you please, but we're going to hang out in the sun, have some drinks, and do some lawn bowling. It's going to be a great time. So if you're in Calgary and you're a fan of the Loonie Hour, come to our social event on Saturday, July 29th. There's tickets below in the show notes where you can get those tickets. Again, $20 gets you in. Unlimited booze, going to be a great time. We'll see you there. I think that kind of brings us to, the next leg of this, right? Which is like, okay, so we've talked about the Bank of Canada. They've got these forecasts, which again, I don't think forecasts and modeling is overly reliable. We had 400 PhDs at the Fed that didn't see all these rate hikes or transitory inflation. So, the world is a complicated place. It's definitely tough to predict. But, now we've got US CPI that came out this week, came in softer than expected, below expectations. We can get into it. US PPI, producer price index, came out today. A whole slew of macroeconomic data. So, Rich, why don't you walk us through, first and foremost, US CPI coming in, not only headline inflation, but I believe core was also below expectations.
Yeah, so I'm looking at it now. So core, again, inflation is still positive and prices are still higher, but the rate of change at which they are accelerating is slowing. So remember, second derivative. Sorry, it's important people get that. I think often that's lost sort of in the literature. Headline inflation fell to 3.1%. And core is still at 4.9%. So again, it's a bit tricky because you have a bunch of components that are going in opposite directions. Stuff that I always like to talk about and highlight, which is used cars and trucks on a non-seasonally adjusted basis, month on month, they jumped, but in general, that's been They went
Well,
from being a
can you
huge.
say it again?
Sorry, on
car
non-seasonally
thing?
adjusted, used cars and trucks month on month rose 3.2%, but that's kind of a counter trend because we've been seeing them sort of come off quite significantly.
Which is funny because I sent you guys that tweet there from like this guy's a
Yeah.
great follow. He's on Twitter. He's called Car
The used-
Dealership Guy. He's got like
Yeah,
400,000
he's great.
followers.
Yeah,
But,
so it's funny because my client actually sent that that exact same tweet. So there's a bit of sort of conflicting evidence here because the actual series I'm looking at it right now is up on the month 1.2. I think I misspoke. I said 3.2. I meant to say 1.2. But you're right; those car dealership numbers are actually coming in significantly. They are falling down.
So, yeah, this car dealership guy says used car prices fell 4.2% in June, the second largest monthly decline in history.
Okay, wow. All right, that's definitely different than the used car and trucks CPI component for the month of June, which was up 1.2%. There you go. Okay, what do I know then? But in general, I mean, this is the same sort of story. I mean, you've got the shelter component, which we've talked a lot about. That's coming off. That's coming off quite a bit. Energy is still a big drag. Something I really like to look at is sort of core services. And that's obviously starting to come off quite a bit. Another thing, we talked about breadth and depth of the inflation. There's a series called from the Cleveland Federal Reserve. That's sort of the median CPI number. And that's now has long since peaked, but now falling. So now it's at 6.4%. So, I mean, the story is, and then, sorry, one more thing is core X shelter, which is also a really important one. And that fell significantly to 2.76%. And so basically we're getting what we've talked about, which is, the worst is far behind us now. And we're seeing basically not disinflation. I don't believe that for a second, but not
deflation.
Not deflation. Excuse me. Thank you for correcting me. But we're seeing disinflation and obviously things are slowing.
Keith, what's your takeaway?
That's the same thing. I mean, without going through those awesome numbers which Keith gave us, on the face of it, core year over year, it's gone from 4% down to 3%. So again, everything is headed in that right direction. So so not only are the numbers headed in the right direction, they're softer than estimates. So, market took this as a, hey, risk on, let's go. So, the US dollar traded off quite aggressively. Equities are up, credit is up, duration is up, commodities are up. Like everything was just flying yesterday. And it's based on the expectation that the Federal Reserve is now finally going to cut rates. So I think this is probably the 8th time this happens, almost a year now. It was last August when we had the Jackson Hole speech. And, that the market is the market. The market is never wrong. It's always right. So you go with that. But let's remember here, everyone who believes now at the Fed that they are going to pause, that the Fed remains hawkish. They continue want to raise rates to get that crushing of the economy. They won't use that word, of course, but the only way to truly, sort of snuff this out is to go in that direction. Now, we do have a scenario. Do we want to jump over to the big elephant in the world that could
I do, but just
deflation, or you want to stay in the US for a while?
No, I'll sort of segue us there. I think I was going to ask you because I think I agree. It looks like we'll get another Fed hike. It's basically penciled in at this point for the month. But does it feel like we're kind of in this turning point now where the data finally, after everyone's been talking about it, the economy is slowly going to soften. And I feel like we're in this turning point where the data now is finally starting to reveal this softness, which is, we saw the, obviously non-farm payrolls, softer than expected. You had this US CPI and basically now getting back down to 3, falling below expectations. We had the US PPI, producer price index today, Rich, showing what month over month was 0.1% or something.
Yeah, 0.2.
Yeah. So just, again, incredibly soft. And then, leading over to China, Keith, which is the big macro story, leading into that, we've got China's property sales were down 32% year over year in June. And after merely 4 months of positive growth, so both CPI and PPI now point to an outright deflation in China. So China's PPI, Producer Price Index, fell 5.4% year over year last month. And Keith, you flagged as well. You had flagged exports as well, had you not?
Well, they're definitely the big panda in the room.
Come on.
Oh, Rich, come on. You usually show me more love with that one.
That was terrible.
That was terrible? Oh,
I thought
dear.
so. Anyways, carry on.
It just came to me. I wasn't even
Sorry,
ready for that one.
I'm off my game too today, so don't.
I wanted to swing back to the Americans for one more thing. So, the markets are saying the Canadians are done hiking. The market is expecting the Americans to do one more hike. And then they're expecting a cut by January of 24. So 6 months out, that there's a cut coming. So again, and it goes back to this conversation, Steve. I think the easy days for forecasting monetary policy, that is over on both the upside and now the pause. Now we're going to get down. I think, Rich, you've discussed this before. Maybe we go into this period where inflation, it's just stubborn. It stays in that 2 to 4%. I know that's a pretty wide case, guys, in our world, but it just stays in that 3% range. And it's like, hey, what do we now? Do we officially change our inflation targeting number and so forth? But so we have that there. So let's put that aside. So back to the big panda here in the room.
Hilarious.
That's the sound. That wasn't a soundtrack. That was a real reaction. I love that one. The panda in the room. We've been talking before about how China, they're giving signals that they're struggling. So you're seeing it in specific headline news coming up all the time. We know they have a domestic growth problem. We also know that their banks are struggling because the central bank, they're lowering reserve requirements and things like that. We're also seeing on aggregate data in that their holding of U.S. Treasuries has been trending lower. And, some people think, they're selling their treasuries. That's not the case. They have less US dollars coming in from trade, which goes to Steve's point about their export machine. So when the Chinese have less US treasuries, it means they are selling them. And that's because they need US dollars to stem or try to slow down the depreciation of the yuan, of the Chinese yuan. And that's been happening quite aggressively as well. So where this sort of inflation surprise can come from, and it sort of goes back to the Bank of Canada presser yesterday. One of the reporters asked them, what would be a surprise for you guys? And, he went from an academic discussion about inflation being at one rate versus another. I think the reporter was really referencing what kind of external shock could take place. And my answer would have been, hey, it could be China. So if the Chinese economy goes into a serious tailspin, so the little tail starts to go around, Rich?
Pandas don't have tails. Well,
they don't have tails?
They're the little fluffy thing.
I've never looked before. What are you've looked?
They have a little fluffy. It's not like a long tail.
Do they have a long tail or no tail?
They have a small little poof thing.
Poof.
Or poof?
It's a cute little poof.
I think that's the technical scientific terminology.
We need to get help on this one.
Yeah, we do.
Maybe you could show a picture of a panda's ass here right now so we can get Oh man, this is the days of summer, right?
Yeah, this is definitely the dog days of summer.
Yeah, it is. However, if the Chinese economy does spiral downwards, that exports deflation around the world. So then we could conceivably be in this period where the Canadian economy is not growing at 1% anymore, the lowest point that the Bank of Canada is expecting. It goes much lower, the American growth story rolls over as well. And because if China goes into a tailspin, it means that they're importing inflation is coming into China, which by default means they're exporting deflation on the other side. So that could be the wild card that would come up here. And if that's happening, then you will most definitely see the central banks in the Western world, start to cut rates, rapidly. So maybe there is a world we go from, 0 to 5 and 5 back now into 3,
Maybe.
3.5, 2, right? And again, we think very clearly we live
It's
in a world
amazing
of
though. Like
extremes.
people just absolutely do not believe there's any hope in hell that's going to happen.
What's going to happen? Sorry.
That there's going to be these aggressive rate cuts.
I'm sharing that there's always the possibility that
I'd agree.
anything, because we live in the policymakers around the world, they understand that we are at the end of this 40-year super rate cycle. It's over. And by that, I mean long-term rates that went from 20% down to 0%. They left them there for 10 years. I like to say, kids went to university and their whole university career was spent in a period with 0 rates. Now they're working for 5 years and they're still, they're coming out the other side. Policymakers have set us up. They synchronize the whole world right now so that we should expect market extremes in any direction. So, hey, if it happens, then all of a sudden, mortgage rates are coming down again,
Party on.
Bull market's back, baby.
Yeah, bull market is back.
Get those pre-sales ready.
I used to be a bartender. Now I own a boat.
That's right. It's gully. But Steve,
but back to China though.
Sorry.
The Chinese export number, and it's not just exports to a specific country, it's exports around the world for China. They are really struggling, and that's a market, again, Canadians should be very aware of, because they could have that could be that external factor. The panda could come in and hip check Canada.
Oh God.
Rich.
Well, I was just going to be careful about Steve mentioned a point about the U.S. job numbers, and they did in fact come in less than expected, and which is why I had to eat a disgusting processed Twinkie thing. But I think it's important to remember there are some key employment numbers that are actually still very, very strong. And I think, just to be the counterbalance to that point, which is one, the shortages, whether it's the NFIB, the National Federation of Independent Businesses, they have surveys just like they do in Canada about shortages and ability to hire workers and expectations for paying them more and expectations for hiring them still okay, still relatively strong. There's something called the U.S. jobless claims. So, when you go so there's initial claims and continuing claims. So obviously when you lose your job, you go to insurance claim and you ask for unemployment insurance or EI, whatever it's called. Those numbers are steady to falling. So I think we have to be very careful. And something that we pointed out several at the beginning of this year, when all of those tech layoffs were happening, whether it was Meta or whatever, Twitter, all these things, so something called there's something called the Challenger Gray Christmas. I don't know. I think it's somebody's last name. A job layoff data series, and that series again, it's freely available online, and it's now making fresh lows. So basically the announced job layoffs are started to contract, and so that would have surprised me, just 6 months ago when everybody was worrying about the job market. And then the final thing is when you look at my favorite, the U.S. diffusion index for the ISM PMI services, we're seeing that the employment component of that broader index is actually relatively okay and has improved over the last little while. So it's just, we're in this weird, like Keith says, it used to be very easy to figure out what monetary policy is going to do, and now it's a bit trickier. But to say that the labor market is sort of done, I don't know. I think it's a lagging indicator, and I think that there's still some strength there. Sorry, Steve.
Yeah, sorry, I wasn't. Yeah, definitely wasn't suggesting it was done. More just okay. I felt like it kept beating expectations, and it was okay, we finally had one that was below expectations, and then you're just more seeing again the PPI, the CPI data coming in sort of softer than expected.
We're so definitely slowing. There's no doubt about that.
For sure. ISMs coming in softer than expected. So I feel like that data anyways starting to actually show up. But yeah, I don't disagree with you. I think it's a tough environment to navigate for sure.
I think what we need to do, this has nothing to do with what you just said, but for the Vancouver event, I think we need to have an investment industry acronym trivia contest.
Yes, great idea.
For freebies, to throw some freebies, right? And maybe the diffusion index definition.
That's a good way to not sell tickets.
But we're all talking about the same thing here. That right now, like the Bank of Canada is calling for this Goldilocks moment. Same thing for the Americans, the Europeans. I did have a note on what's not happening
Well,
in
Keith,
Europe.
I think
by
like
the
the
way.
biggest takeaway that I'm sure you'd appreciate is like it's kind of like it's like this linear thinking,
Right.
right? It's just like, oh, it's gonna gradually slow and inflation will just gradually slow, and everything's just this straight line projection based on what's been happening over the last 3 to 6 months. But as we know, there's pandas in the room that can bring shockwaves, things that people didn't expect or didn't, things that you can't put into a model.
Yes, panda's my joke.
Sorry.
What do we call the Europeans? Because according to the Bank of Canada, their economy is effectively stalled. Germany, which was in recession last quarter, has continued. The IFO, another diffusion index, I think. Anyway, their very important economic indicators are coming down. They're seeing a lot. The economic surprise index, which is a really, really cool series, which basically compares sort of what the market is expecting, what analyst expectations are versus the actual data that comes out. That series is basically horrendous, which means that the data is coming in much, much weaker than what has been expected. Europe's in trouble. You got China not doing so hot. Really, it's just the US that's like holding up the whole world
And that
right
could
now.
be enough.
And
so traditionally, the Americans rather drag everyone down or bring everyone up. So,
it's a good
what
point.
what we absolutely want to see, from an overall financial health of the world is for the Americans not to have any stress. Maybe they get, low growth periods with everything else is worked out and they'll be fine. I think that is the best what we can hope for. So we don't experience in extreme, and that we get, perfect socialism, for the next, as I don't think it's going to happen. So speaking of socialism, so back in 2020,
Here we go.
European stimulus package, they call it the big Green Deal, I think. Remember, it was a 620 billion euro package. So at the time, I think it was almost $1 trillion USD. I think, what was the euro back at the time? Was it in the 120s, I think, maybe something like that. So it was a big number. So remember, 620 billion euros. Guess how much of it has been raised so far and allocated? 82 billion.
Why? Sorry, I don't understand. Don't they just borrow it from the markets and then just spend it, or do they have to raise it from the constituent parties?
It's an unfunded spending program.
My favorite type of program is the unfunded program.
So it can be good or bad. So for example, if a government doesn't borrow as much as they wanted to and spend it, sometimes that's really great. If you have this program that's announced to help bring your economy out of the depths of a global pandemic when they shut everything down, which caused it to be in a position to have to put in this stimulus package, and then they don't spend it. So again, it's just another example where we should not expect the Europeans to be able to provide stimulus to bring the world out of any kind of funk. So that's why it's always coming back to the Americans. And of course, right now there's a lot of loud calls for the Chinese to do it, because nobody wants a weak Chinese economy. It's not good for anyone. So like a lot of the headline stories you'll see now over the next few days, I imagine on the weekend especially, it's going to be directed towards the Chinese over there.
But to their credit, they have been doing that. It may not be enough, but they've lowered reserve requirement ratios, they've lowered deposit ratios, they've done stimulus, they're starting with their make work programs again. There's a bunch of monetary policy and liquidity things that they've done, and they've told banks to lend. Again, it may not be enough. I think one of the more interesting.
But it's doing the same thing to expect a different result, because there was no Chinese miracle. It was just debt, right? That's all it was.
I don't necessarily agree
Steve
fully with
chuckles
that.
in the background.
I don't necessarily agree with that fully, but I think one thing I think is really interesting, and we haven't talked about it at all, is the youth unemployment rates in China are now higher than half a dozen European countries. And that hasn't always been the case. And I'll share that chart.
That sounds great for social unrest.
Well, that's the what is it, Keith? The panda in the room. I mean, that's the other. I mean, it's just amazing. Like, I think we're abusing that.
It's funny when Rich does it. Steve got to hit it a bit harder though, a bit sharper with the panda.
China's youth unemployment is something that I think we should all sort of just keep an eye on, right? Because part of what that makes that system work is the Faustian pact between the leadership and its constituents. And the trick is, okay, we will be in control of, and we will manage our economy, but we will raise your standard of living. By hook or by crook, they've raised their standard of living in China. That's unambiguous. They've pulled hundreds and hundreds of millions of people out of poverty. And now when you see a youth unemployment number starting to creep higher and higher and higher, I think it really sort of changes. It's just, I don't know what's going to happen there, but it's just fascinating. It's something I think we should definitely keep an eye on.
Man, all those shutdowns, the lockdowns there. Good idea. I guess not.
Well, I'll share that chart on the Substack, and you guys, I mean, it'd be interesting to hear the comments from people about that, but it's really interesting.
So I have another point in my notebook for today, and I wrote it early. So I was up quite early this morning, driving the wee one around to do some stuff. And I had this brilliant idea, and I wrote it down. And as the day went on, I'm thinking, I don't know if it is such a great idea or not. And so what I wrote down is that, here in Canada, we should actually, so if anyone in Ottawa is listening, have a think about it. There should be a referendum on a central bank digital currency. Let's put it, to the people for a vote. That's my idea. And I'm thinking, you know what? I think there's enough pushback on this. It shouldn't be designated to whoever you elect for your riding, who will vote along party lines anyway, who maybe they don't understand it. However, and then as the day went on here, I'm thinking, wait a second, like only Loonie Hour people will understand what the central bank digital currency is. And it probably, maybe a referendum won't be, a strong enough tool, because the way it will be sold from a media perspective, that is not a bad thing. But I know I keep going back to the central bank digital currency concept, because if we do roll into this debt problem, which I think there's a very high probability that we are going to experience, that would be the logical, next step, to step in to bail out, different kinds of banks and households and so forth. But how would you guys do it? Like, how would you?
I'm definitely not a fan of plebiscites on technical policies issues.
I think that
hashtag Brexit, which was I think that's as a starting point of why you don't do those kinds of things. Number one, those kinds of things only work in countries that have the muscle memory to do it. So it works super, super well in a country like Switzerland, where they vote on absolutely everything: the height of the minarets, the color of the color of the fire hydrant, whether you can eat bagels on a Saturday. I mean, the Swiss vote on absolutely everything, and in a country like that, it works super well. I think in a country like this, I don't agree with that at all. They should just not do it. No central bank digital currencies. We don't need a plebiscite.
Maybe. Well, I got a story to bring up here too. I wanted to squeeze this one in at the final hour. Speaking about voting for people and having the authority to vote for certain positions, perhaps we should be voting for the federal housing minister, who was obviously appointed by Trudeau. So he sent out this tweet. The only reason why I'm mentioning it is because I don't think I've ever seen a larger ratio on Twitter. Like, this guy just got beat with a stick. I don't know, whoever his comms guy is needs to be fired immediately. So the housing minister, Ahmed Hussein, he wrote a tweet, which he actually, funny enough, he pinned to his profile. And he says, quote, "Now is the time for solutions, not political theater. While Pierre Poilievre and the Conservatives are focused on cuts and far-right rhetoric, we are focused on one thing: bringing everyone to the table to get the affordable homes Canadians need built now." And then he basically wrote an op-ed, which is in the National Post, in which he literally went on. The whole article was just political theater, bashing the Conservatives' policy proposal for building homes and saying that it was not going to be effective and that we shouldn't blame the municipalities and we shouldn't blame the federal government essentially for the housing situations. Essentially, what, for those that are following at home, Pierre Poilievre has basically come out and said, hey, listen, hey, elect me, I'll get in. How I'm going to do this is I'm going to basically cut municipal budgets, the money that the federal government gives these municipalities, unless they hit certain building permit requirements. So basically, you play ball and approve more housing or you ain't getting funding. So that's kind of his thing. And so this guy basically wrote this op-ed and said, that's stupid. That'll never work. We need to, like, you know, join hands with the municipalities and sing Kumbaya, and we'll get housing built. And like the fact that he wrote this as housing minister, which has literally done nothing for new housing supply, house prices have doubled since 2015, since they were elected. This guy has probably the worst track record on housing of any minister. And so, yeah, he just got absolutely obliterated. And, you know, funny enough, looking at this, so residential, we've talked about this in the show, but residential permits right now, residential building permits in Canada on a 6-month seasonally adjusted trend are running at the lowest levels in almost 15 years.
Is there a data that show backlog? Like, is this, it's just not enough being applied for, or is it the
everybody's
the approval
not,
end?
It's basically like, if you're a developer, like, are you going to, because when you submit, let's say a development permit, right? Like, you basically have, like, so you're going to spend all that time, money, and you're going to apply for the permit. You typically have about 2 years to act on that permit. But if you're looking out and saying, oh gosh, like, I don't know, mortgage rates going up, central bank says, you know, we're going to keep raising rates and we're going to have to hold them here for a long time. Like, it's not a very appealing environment to be out there actively building housing. So as these guys are importing 1 million plus people into the country, unabated, housing permits are collapsing. And this guy, it's just, I don't know, it's just completely tone deaf. And honestly, I think this guy should resign. It was disgraceful.
Give us some examples
I was
of the
vehemently,
replies. Give us some
horrible.
examples. Yeah. Give us some of the more children-friendly replies.
Oh God. I mean, just this guy, I mean, anyone can go back and pull it up. I don't even want to go back right now, but
well, I have some constructive sort of addition to this conversation, which is to say, I think it's important to remember that you can, from a top-down perspective, improve housing supply. And we're actually, and ironically enough, it's from a left-wing government, and the government I would submit to you as evidence. Oh no, I was going to suggest New Zealand as an example. Okay, so not a totally different country from a cultural perspective. They have they have really, really high housing affordability is horrible there. You know, house price to income ratios are similar. House price to rent ratios are similar. They borrow at the front end of the curve like they do in Canada. You know, you could argue it's a Commonwealth country, mostly white, mostly Christian. I mean, it's basically a former colony of the UK. So lots of similar comparable things. Lots of space, the population concentrated in 1 or 2 cities. So you can see the stack, and you can stack the comparables, and yet the legislative body, the government in New Zealand has basically forced down rezoning rules and has increased supply significantly. And now, listen, obviously there's a lot of work to do, but you can, from his position as the housing minister, affect some change in this space. So I think I read the article, Steve, and I think it's just bananas what he wrote.
Well, the fact that he wrote, now is not the time for political theater, and literally just wrote a piece bashing another political party, like whether it was bashing the Conservatives or bashing the NDP, is like, you're literally bashing another party, but yet you're the one that's in party for the last 10 years and you have literally done nothing. You have like the worst. It was just, honestly, it was pathetic. So what the federal government should be doing, again, hypothetically as housing minister, is they should actually be stepping in and filling the void right now. So what's happening, right, is the private sector is turning off the dials. So again, you can argue, I would say you could probably thank Tiff Macklem for this. If your cost of construction surges, 500 basis points in 12 months, a lot of projects die instantly. And so the only way the private sector is rightfully stepping back because they have a profit and loss balance sheet. The federal government, I think, should be filling the void today and saying, okay, we're going to build purpose rental buildings. You could repurpose empty office buildings. The Canadian government owns a ton of land. So they could be building on that land. And so I think they should be filling the void there. They could then try to incentivize the private sector. There's been talks about, getting involved in working with the provincial governments to remove HST on purpose-built rental housing. I think they could actually remove GST as well. Because what happens when you build rental housing, you have to self-assess GST, which is the dumbest thing I've ever even conceived. So that could be removed. So there's a lot of things that these guys could be doing as opposed to spending their time writing op-eds and taking pictures on Twitter when they build, 11 new units in some remote town.
So I did a co-op program at university. My very first job when I was in university was with Revenue Canada GST.
Tell me
so
more.
I was involved with as these GST assessment returns they would file. That was the official title. What I really did, I ran the office hockey pool.
Before Yahoo.
That's an important job.
Before the internet.
Yeah.
Before the internet, that was a full-time job.
It was, I don't know, it absolutely was.
Yeah, the commissioner of the hockey league is a thankless job.
Anyway, guys, there we go. I think
that's a good place to wrap it up. To the housing minister, if you want to come on and rebuke my comments and have a debate, you're more than welcome to send us an email on the show here. But as always, guys, we appreciate your support. Just again, a subtle reminder, our Vancouver event here on July 27th, about 75% sold at this point. So still got a few tickets kicking around. Would love to meet a lot of you guys. A lot of our listeners here. And so July 27th, there's a link to the Eventbrite page to purchase tickets in the show notes. So go check that out, and we'll see you next week.